warriors here in face and warriors joining us, viewing us, being live streamed at investing.com. We have a great shoe for you today. I know most of you guys aren't old enough to remember Ed Sullivan, but that's what he used to say. We have a great show, and I want to point out initially again that we were voted best newcomer at FX Street. That's the award, that's the decal, that's our trophy. We beat out a lot of excellent researchers, tacticians, analysts for the best newcomer on FX Street. Everyone doing okay? I have Patrick Wilson, a very timely topic today. He's going to be talking about trade wars and what the implications could be for markets. In fact, I think there's a big vote today in Congress. It started with solar panels, and now we're talking steel. So something Blake had talked about a few months ago, that we were going to enter this phase of tariffs and retaliation and trade war brewing. It's now underway. So Patrick is going to talk to us about it. He's an expert with a very high-end analyst firm. So looking forward to that. And it's been quite an interesting week. So let's get to the markets. Starting off with crude, on Tuesday I talked about the non-confirmations up here, the correlation between crude and the stock market. My thesis was this was going to be a failing rally, that we weren't going to take out these highs. Talked about that we were above the 61.8, even though I saw divergence up here. If you wanted to be conservative, you waited until it traded or closed back under 61.8. If you did that, you have plenty of pips. So if you took that call, Steve and I are in a little bit of disagreement. I'm thinking we take out these lows and we head back down, possibly all the way down to the 54 level. We'll see. We're now approaching some retracement levels here of the recent advance where it may be able to dig in its heels. Of course, the key and the linchpin always is the Dixie, and the dollar continues higher. Today we're starting to get towards certain levels we talked about after we broke out of this bull flag. In fact, I want to again emphasize that if you were here in our face webinars, that Pipzar Blake Morrow up here talked about this being a false breakout for, this is a daily chart for about 8 days, and said that it looked heavy all the way down. We're now heading towards this 121 level, which are previous highs here. So we've been talking 121. Blake's been talking 121 for a while. Could be there today, or most likely by Tuesday. So the S&Ps, you had the same scenario that you had in oil. So if you, in fact, I tip my hat to Steve Bulge, because Steve caught this and then was looking for a rally towards 2,800. Close enough for government work. We got up to 27.88. Again, this was a 61.8 level right here at this 200 moving average, and it was like crude. So if you wanted confirmation before you got short, you waited for this candle back under the 61.8, which came in around 27.48, and there's 40 handles for you right now. So we're going to see how tough our new Fed chairman Powell is today. I believe he's on the Hill again, and he was talking like a hawk here. Let's see if he switches to a different type of bird, like a dove, because the market's under pressure, or it's really his intention to take some of the air out of asset prices and asset bubbles. And you got to say, if you thought 2000 was a bubble, and you thought 2008 was a bubble with the financial crisis, you can't say this isn't. On a weekly basis, very negative looking. We're on the verge of taking out last week's low, which would be an outside week. And the leader to the downside has been the Russell, which I track through the IWM. And we already took out last week's lows yesterday in the Russell. Here you go. See, here's last week, took out the highs early, went to a back test of the wedge, took out last week's lows, and we're already retracing about half of this recent rebound. So critical day, my best guess is that the sell-off in the market continues into early next week. Same with the dollar. Dollar strength continues into early next week, and then we see a reaction. I know it sounds a little bit far-fetched, but what I'm hearing from most people is that the lows are in. I was hearing this here, that everyone thinks the lows were in the S&P and the Dow. The strength has been the NASDAQ. NASDAQ holding up much better than the S&Ps and the Dow. But when everyone agrees that the lows are in, and I look at this Russell right here, there's a possibility that we flush out, have a panic into early next week, and then we get a better rally than we had from here. So I believe we have Greg here today, or possibly Andre's with us too. So I want to hand it over to Blake and see what Blake is saying now that we're getting a little long in the tooth in the dollar rally. Good morning, Blake. How are you today, partner?
Good morning, Dale. How are you doing?
Good, buddy. So dollar continues. You know, I am starting to get some non-confirmations in the Dixie and some of the shorter term time frames, but I'm not ready to fade it yet. How about you?
You know, so it's tough. I mean, we're at kind of a tricky situation. My two thoughts, I have two thoughts, 2 cents, is that is the euro dollar still, you know, moving down towards the 121 level. I think we're going to see that for the you know, Italian elections. And I think following the elections, there's going to be a decision to be made around 121. So as you can see, we're pushing the lows that were posted here on the 18th right here, and we're trading at them right now. So and this is in the euro dollar. The euro dollar is obviously you know, the kind of like, I want to say the leader, but it's really not, because if you look at the cable is really, you know, dragging the entire, it's dragging the entire dollar complex higher right now. But the euro dollar, you know, we're getting to that point where you got to start being a little bit more careful on the short side. You know, everybody's thinking that Jerome Powell is going to be pretty hawkish today. I mean, that's like the given. But you know, after seeing the stock market reaction and you know, the dollar's reaction, maybe it comes out a little bit. Yeah. Maybe he reins it back a little bit and kind of you know, takes a little bit more of a dovish stance. I don't know. I would be looking at more of the you know, if Powell tries to walk back some of the comments, or maybe, you know, sounds a little bit more dovish today in the Q&A, because the prepared speech should be the same. What I would be thinking is that you get a euro dollar maybe back up to 122, 30, 40, 50, somewhere up in this neighborhood, and then you look into sell into that strength going into the Italian elections. That's my initial thought right now. I do have a tough time selling the euro here, and I have orders out, had them out all night to sell at 122.50, and never got triggered, you know, obviously. Sorry, I got up a little early this morning. I, you know, kind of, you know, opened my eyes and sat there and said, well, I'm not going back to sleep, so I got up a little earlier than normal. But again, I look at the euro dollar, and it's like, it's hard to be a seller here. You look at the 4-hour charts, we're obviously pretty oversold at this point. We can become more oversold. You can see RSI gets even further down here on these last legs. So we could continue lower, but it is tricky now. It's not as easy to take this trade as it has been for the last few days, where it's been what I've predominantly been doing is just playing long the dollar. You notice like there's the dollar Swiss. It's right up here against resistance, and this is really key too. And by the way, I did sell some dollar Swiss, and not sure if I want to stick around, but this is all real big resistance through here, and so we're right up against it again. And the market is, you take stocks, and stocks are a little heavy. They're still trading heavy. We're below this upward sloping trend line in the S&P. The Dow broke it as well. You can see the Dow broke that trend line too. So the market is trading heavy, but you got to be careful here. I'm not 100% sold on the fact that we're just going straight down from here, or the dollar is going to continue to go straight up. I think that we have to pay pretty close attention today to, we have the PCE, we have income, personal spending, personal income, obviously unemployment claims today too, which isn't really much of a factor, but those numbers being released today, especially personal income and spending, what if the data comes in worse than expected? I mean, we are expecting personal spending and personal income to come off a little bit, but how about if it comes off a little bit more than analysts expect? Does that sink the dollar a little from here? I look at there's a couple things that, well, actually I might sell the pound New Zealand once again. I might be a seller here because we're coming right into previous support. Like the pound New Zealand, this is a currency pair I shorted overnight, and I already took profits. But take a look at the reason why. And if you guys follow ForexAnalytix, you at least got the analysis yesterday. I didn't put a pattern in play because it's not to where I'm real comfortable being on the short side. But let me show you a couple of things here. Grab a pen. So you'll notice that we rejected at the 618. We hit a new high and reversed, right? And we came off bearish engulfing candle right there. You see it. And now we're coming into some trendline support. If that breaks, that's going to be kind of ugly. And the fact that we had a false breakout to the highs and hit a key fib and then reversed, it was all the genetic makeup for a bit of a reversal. Now, in order for this to really reverse, we'd have to see a bounce in stocks. And I look at the stock market and I'm like, I don't know if it's gonna. That's why I kind of took profits this morning. I was like, I don't know if we're gonna see much of a bounce yet. But at the same time, I know a lot of people have been getting really bearish over the last 24 hours in the stock market. And the problem with that, Dale, as you know, is when everybody starts to get pretty bearish. I've seen a lot of situations over the last, few weeks when people get extremely bearish, the market just rips right up in their face, or vice versa too. People get really long on this breakout and they go home long, and all of a sudden they get slammed right back in their face. So I think you got to be pretty nimble here. Nothing's clear as it was this last week. I think this last week it was really clear. The last week and a half, and hopefully you guys have done well. I've managed to have my best month in trading in 6-7 months maybe, just in February. And but it was clear for the last, like I said, last week or two. Today, not so much. I'm not 100% convinced on anything that I'm I'm doing right at the moment. But let's take a look at, you know, some of the majors and just kind of, you know, go through them. So the euro dollar, you know, again, it's trading pretty heavy. We're at this support here. I do think we're heading down to 121, but the question is, do we bounce to 122.50 before heading down to 121, or do we just go straight down to 121? I think a lot of that has to do with the Powell testimony today. The pound. I have been in and out short this thing now for the last couple of days, and I managed to make a little bit of money in it yesterday after totally floundering a couple of the day before trading it short up here. But the pound dollar is, you know, it's got this triangle points all the way down to the 200-day moving average. Yeah, if you look at the pound dollar and you go, well, can we really hit the, come on, Blake, can we hit the 200-day moving average? Sure, why not? You know, Dale, what's this called here? I know you probably have it on mute, but I'm going to ask you this question. What is this called right here? Your famous trade setup.
Oh, the three drive up there?
No, well, maybe it is a 3 drive. I'm not sure how to read a 3 drive as well.
Oh, you mean a throw over,
yeah,
and then inside?
Yeah, nice little throw over this channel here. You know, got everybody super bullish, and then to reverse and break back through the lower end of the channel wouldn't surprise me.
Like what the euro did. Only I'm not sure if the euro was a throw over, but you love these false signals because big trades happen. Because you have more people the wrong-footed that need to be liquidated out. So,
love them.
Yeah, it's a contrarian trade. You know, we're contrarians at heart, aren't we, Blake?
What we are, but you know, as a trader, I'm more of a predator. So, when, you know, contrarian, you can call me contrarian. You know, which I tend to be. But then again, you know, I try to find trends early, because what I've found in my career, and you probably would, you know, echo the sentiment, Dale, is when you find a trend early, the turn is usually the biggest and most explosive part of the move. So, you know, when I can find, you know, this false breakout and reversal, this is the, you know, big chunk of it that comes up real fast, and then we're seeing the, you know, second round effects of that. I think
that's what Paul Tudor Jones says, Blake. He goes, all the big money is made at the turns.
Yeah, so you know, I that's why I was again, I don't want to toot my own horn, but I'm fairly proficient at finding the turns as just before they happen or just as they're happening, and that's always been my strength. Sticking with the trends has always been my weakness. So you know, like riding out a trend that goes from, you know, like the euro dollar goes from, you know, one you know, 06 to 118 is always difficult for me to do, you know, but I'm good at identifying this part of it, you know.
I mean, who would have, you know, everyone says Bitcoin, you know, went to 18,000, but you know, even if you bought it at, you know, 1,000, 2,000, you would have been happy with, you know, 6,
yeah,
you know, triple. So to me, when I see those kind of moves and they're happening, I think the only people that are there are the naive and the greedy, because you know, you almost have to be naive to think it's normal to be able to sit and ride a move like that, or just so greedy that you just don't want to book it. You know what I mean? So
yeah,
I'm with you.
So you know, again, the pound, you know, just looking at the pound, I think it is doable that we get down here, and you know, is it going to be all dollar strength? I don't know if it's going to be all dollar strength. I think it could be all pound weakness. I mean, you look at, you know, some of these pound crosses, and you know, you look at the pound Aussie, the pound New Zealand. You know, they've gone really far. The euro pound, you know, could easily go back to 90 pence, maybe even higher. You know, I don't know if it's all dollar related, and there's a lot of you know, with the you know, UK, EU, you know, draft proposals for Brexit kind of going by the wayside, and finding some stumbling blocks, you know, maybe perhaps the pound is going to feel a little bit of pressure to get down here. you know, I look at the Aussie slipped below the 200-day moving average. It's been a nice, you know, drop since then. We were looking at it, finding some support down here at 127% extension. That's been drawn on ForexAnalytix for the last couple of days. The Kiwi dollar, even though we have a double top here, we have a lot of support here at the 200-day moving average. It's one of the reasons why I shorted the pound New Zealand overnight was also because of the Aussie New Zealand. The Aussie New Zealand had this was a big reversal candle yesterday. This one, see that gravestone doji? That is huge. And matter of fact, you know, you look at the Aussie New Zealand candlestick analysis yesterday. Aussie New Zealand posted a gravestone doji, which is bearish. Boom, that was a bearish reversal, and that I knew that reversal would keep the Kiwi fairly strong going into overnight. So that's why I chose to short the pound New Zealand, because I already knew the pound was falling out of bed, and if you threw a stronger New Zealand on it, you were going to get a lower pound New Zealand, which that's what we got. Dollar Canadian, this thing is mega strong, and but wait, hold on, before you get too carried away with this dollar Canadian here, let's do this, because I haven't, shoot, that didn't come out right. We are pretty darn close here to completing this flag pattern that was here. Let's go over to the US dollar Canadian. Let's go to the basic technical analysis, 1 hour. There's a 1 hour. There's as it was happening. That's the bull flag pattern. That's the bull flag pattern. We're at the 161% extension. You notice the dollar Canadian. Look at how overbought the hourlies are. We're almost complete. I mean, we get up another 15, 20 pips. I wouldn't want to be long the dollar Canadian here. I'm not saying that the dollar Canadian can't continue to go higher. I just would rather buy it cheaper rather than pay up for it here. I mean, you think about
this was a trade when a lot of people were bearish. Greg Horvat was really, you know, stuck with his conviction when it looked pretty negative down at 122. Still looking for 131, I believe. So hats off to Greg Horvat on the Canadian call.
I could totally see that. I think what's going to happen here is you're going to, you know, do this and then you know, something like that. You know, it's not going to continue to go straight up, especially with hourly RSIs getting a little ridiculous here. So you got to be, again, if you're long the dollar Canadian, be a little careful. I mean, you know, just be cognizant of where we're at and where we've been. I mean, you know, you think about, if you think about just a couple of days ago, this is the 26th, right? So the 26th was on Monday, Sunday night. We were trading at 126.20, and now here we are 200 pips higher. You want to pay up for that? Think about what you're doing before you do it, and think about what you're paying for. You're paying a huge premium. You know, you're paying a let's do the numbers here. You're paying a 2% premium on something. Are you willing to pay that type of premium as an investor, as a consumer? You know, somebody was buying it. The smart money was buying it 2% cheaper than you were last week or earlier this week. So here you are, paying up for it. Is that what you really want to do? I mean, can it go up 4%? Sure, but is it realistic to believe that you're going to see 2% swings in currencies over the course of 4 days? Normally, not really. If we get a 1% move in a currency in a day, that's huge, and usually we take a breather after that. 2% in 4 days is a big move for a currency, especially when there's not a lot behind the move other than just technical squeezing, which I think has been predominantly the case as of late. Oh, I forgot, this is investing.com day, isn't it? It's Thursday. We've got all these
yes,
we got all these traders from investing.com.
That is correct. That is correct.
Okay. Well, welcome for those of you that aren't normal listeners. Here's the thing, Steve. Here's the U.S. dollar Norwegian krona looking at a possible Gartley pattern if the dollar continues to stretch its legs. I really don't think we're going up here, but I drew it out just to, just in case we do, because I sure as hell would like to be a seller of the US dollar Norwegian krona up here at around the 8 level if we can get it. I just don't know if we're going to get it. US dollar Swedish krona, this has been a massive mover. I sold a little bit this morning, but we're at 161% extension. Big move. And they just got to be really careful, because now look at how overbought this is. A lot of this is on the Riksbank and how dovish they've been, and the inflation data has been kind of weak. So US dollar Swedish krona has been rallying, but hey, we get some weak US data today. This US dollar Swedish krona is going to get back a lot of these gains. Peso, Donald Trump talking trade overnight. This is actually, believe it or not, this is a Gartley pattern right here. I'm not a seller right now. I still think we're going higher. This would be an 88% right there. It's right close to that. Anyway, that would be like a semi-quasi Gartley pattern. I would be a seller up at 1910. I've been buying the dollar Mexican peso for the last 2 weeks as we were dipping and holding the 200-day moving average. And so, I'd been buying it for the last couple of weeks. Now that we're up at these levels, I'm not necessarily a seller, like I want to short it, but I am being very cautious to be on the long side, even with all this trade talk that has come out overnight with Donald Trump talking about aluminum and steel, and just basically taking a tougher stance on trade, which tends to be more peso bearish than anything. I think we're getting towards the tail end of this up move right now, so you have to be a little careful. The dollar index. So as you guys know, the dollar index has this bull flag pattern, really completes around 91.50. Ultimately, I think that's where we're going by this weekend. With the Italian elections, with the Italian elections, and and that coming up on Friday, I believe that the dollar index could be very easily be trading up at this 91.50 level by then. I am not playing it long today just because, but what I would be looking is to buy a dip, just like the euro dollar. I'd love to sell a rally to 122.50. I would still love to buy the dollar index down here, maybe at the 90.50 level, on a dip. I don't know if I want to pay up to these prices at this point, but if you don't know this is why it's so significant. This is the dollar index. This is the big downtrend line, and it's been since Donald Trump has been in office, and we've been in this big downtrend. I don't expect that downtrend to change. So therefore, any continued squeeze in the dollar index going into next week up towards 91.50, 92, I am looking to sell into this strength if we get up there. And basically, that's how I'm looking to trade it. So with that being said, I just realized I got 2 minutes. Steve, I'm going to pass it over to you. We have inflation data, so I've got to get in front of my trade station to trade it. So
absolutely, Blake. Absolutely, I'm here.
All right, guys. Well, hey, have a great day. Those of you that are new to the broadcast, welcome to our family, and thank you for being here. For the rest of you guys and gals, I'll see you in the chat rooms, or I'll see you tomorrow. So thanks, everybody.
Good hunting, Blake, indeed. Stelio, are you here?
Yes, sir, I am.
Okay, help me out a little bit with data. Good morning, my friend. We have data in 30 seconds, so let's have a look at them, and then I'm going to start covering, because we have quite a lot of things to look at. So let's say it's a matter of seconds. We're expecting several data. As you see, continued jobless claims, core PCE, initial jobless claims, personal spending. We have quite a lot coming out. Current account for Canada.
It looks like Powell is speaking later today. I have no idea where.
Yes,
that is.
that's true. That's true, Stelio.
I don't remember where he's speaking, but anyway, we can find out.
Okay, let's see. Okay, we have USD yen here at the bottom.
We have some Canadian data as well, but yeah.
Yes. Main ones are US data, and then we have in 1.5 hours from now we have manufacturing data from the US.
Core PC is in line. Everything else is slightly stronger. So personal income slightly stronger.
Yeah, PC in line indeed.
Overall, it's probably more like a non-event actually, because the main items are in line.
Yeah, Canadian current account slightly better than expected, minus 16.35 instead of minus 17.5, which was expected. And as you said, everything more or less. Let's call it in line. So yeah, we shouldn't theoretically see any big responses.
By the way, Andrew says it's a Senate Banking Committee for Powell's speech. Thank you, Andrew. I didn't know that.
Okay, good. So we can, okay, so the data more or less non-event. Let me see here. Month on month, year on year, all in line. Yep, okay, yep, as we said it. Okay, good. So let's have a look at a few things. First of all, just a few minutes ago, I booked half of my short Dale. I didn't do it yesterday. You know, I had a much lower target, so I booked 2.8% on half of my trade when we were down at 2,700 in the S&P. I think that there is still potential for more downside. We might see some slight rebound, but I think that we can easily drift down towards the 2640 area. So you know, I'm far from sure that the sell-off is over. That's why I'm keeping half of my position. Also, if you remember, we had shown that the DAX had also been at a very nice spot for a rejection, and that's exactly what happened after trading within what seems to be like a textbook bear flag. It got rejected from the confluence of the 38.2 and the expanding triangles support, this time acting as resistance. So the DAX also behaved, you know, very nicely here. Same thing happened with the FTSE. It gave us a little overthrow for like half a day there in the from the 38.2 and horizontal support resistance area, but bottom line it got rejected from there as well. So another push towards the 7,100, and if we break below there, perhaps even to new lows, is quite likely. So our outlook having to do with the indices remains unchanged. We had warned that people should not be buying into strength, but rather selling into it, because you know there was no chance that we would be breaking to new highs directly after that kind of a sell-off that we saw. By the way, this is the Nikkei as well, because the Nikkei has an equivalently interesting pattern. As you see, it gave us like a pennant correction, and it's breaking below that as well. So another push towards the 20,500 area looks, you know, very probable. So I think the situation with risk remains what it is. Now, on the other hand, just to give an update on my positions, I also took 1.8% off on my Aussie short trade, just a few pips higher from where we are, because if you remember, my first objective was the 77.40 area. And you know, I'm keeping the rest because I think that the next area of support is exactly 100 pips below at the 76.30, 76.40 area. So you know, why not? I think you know there is big potential for that to happen. And my third position is the position I initiated 2 days ago, being short the palladium at 1,046. I posted that on the chat room, and you know, yesterday it more or less did nothing, and today, you know, I'm quite happy to see that it has moved like almost $40 lower. I'm gonna book half of it a little bit lower from here, because my first objective is 1,000, and my second objective is actually $100 below that at 900. Let's call it 910. So you know, this has been a good month twice already, the first week of the month and this one. You know, I'm not looking to take more positions. I'm quite happy with what I have at the moment. Blake already mentioned the euro. I think that the euro, as Blake said, is a tough call to be selling, because I think that the potential for finding support at the 121 area or 120.50 area is quite substantial. So, you know, although we have broken up below this ascending channel, you know, in the long-term view, it remains, you know, quite a strong one. Same thing applies with the cable. I know that a lot of people have started turning like more bearish the cable, but you know, for me, the cable, and we said that when we were trading quite a lot higher, like above 140, you know, the cable could either be in a triangle, which we said several days ago that it doesn't end up looking like it, or it can be like in a simple ABC correction, which, you know, it's quite likely, and in which case I would probably be more inclined to be looking to buy it if we get lucky and push lower towards the 136, 136.20 area. So yes, it remains under pressure. There's no question about it. But I think that it hasn't turned bearish, you know, in any way. So you know, I think that finding support at 136 is a very likely scenario. I think that the sell-off has been more or less orderly. I do think that in the longer term, it will move quite lower from here, but I'm absolutely not convinced that you know, this move that we saw that started at the end of 2016 to the upside is over. Okay. So the USD yen. What I have to say about the USD yen is that I would still be very, very anxious if I was to be long, simply because this looks to me like another consolidation, a bearish one, potentially. This looks to me like another triangle. And, you know, we've said many times that triangles are formations that usually break in the direction of the trend, which has been lower. So, you know, as long as this is just another consolidation, having found support, you know, at a very important support area, you know, unless we break higher like ASAP, I would be looking for another push lower, you know, towards the 100 level. And as we've said many, many times here, keep in mind, the big picture is that the USD yen has broken below a very, very important trend line, right? One that we have respected since the USD yen switched after decades of being bearish to being bullish. And, you know, this is something you should definitely not dismiss.
Steve, remember a long time ago when we were, you know, kept rallying, you know, 118, and, you know, a lot of people were very bullish US dollar yen. And if you have,
as it always happens near turns, right?
Yeah, you know, if you'd have your weekly up there, something that sounded completely outlandish is, you know, the first break you had from 126 down to the lows of July of 2016. And then if you took that from the high that we had in October of 2016, I think it measures all the way down to like 95 or something like that. Just equality.
Which is very likely.
Yeah.
Which is very likely. It's what we've said multiple times, that keep in mind that markets need to not only correct in price, but also correct in time. Meaning, a lot of people dismiss the fact that we found a low ahead of Abe's reign in Japan. We found a low down here, right? It was 2011. It was the end of 2011, and we actually topped in the middle of 2015, right? So this was almost a 4-year relentless uptrend. Yeah. Relentless uptrend. I mean, there were people that were looking for opportunities to be buying, and the market just didn't want to give them that.
Yeah, you know, after you have a 4-year trend like that, people will buy breaks for years, saying that every dip is a buying opportunity, because it's ingrained, like the stock market. You know, it's ingrained in them. That and, you know, I've seen it in bull markets in gold. You know, from the high that we had, I don't know, back in 2013 or something at 1900, people have been buying breaks in gold that every break was a buying opportunity.
Correct. So people don't realize the following. This currency pair rallied almost 70% in 4 years. 70%. I mean, these are moves that even if you see in a stock you're like, more or less astonished. You're like, oh my God, really? It appreciated 70% within 4 years. Of course, it's not something unprecedented for stocks. We've seen more than that, but still, it's like a huge move. And now consider that this is a currency pair, right? So 70% higher in 4 years in a currency pair is like, insane. So naturally, after such a move, the market, even if it wants to remain long-term bullish, it needs time to, first of all, correct in price, and second of all, correct in time. And that's what we've been seeing. So, it's quite likely that we even move down to 100 or like to 96. And, still USD yen might at some point resume to the upside, right? It might. Regardless, I think this break is a break that we should definitely pay attention to, because in the short to medium term, it definitely keeps USD yen under pressure. And, if we break below the recent lows, I see a huge pocket of thin air here, like between 100 and let's call it 570 and 170, like it's 500 pips of like very little support if you look at it. So, there is a potential for USD yen to resume lower, and, likely quite a lot more than people might be expecting, because I still see that sentiment having to do with USD yen in general is not really bearish. I mean, you do see that sentiment has shifted for the yen, and it has been hitting on occasion extremes for people being believing that the yen is going to appreciate. But in general, if you ask somebody what do they think is going to happen to the USD yen, like in the medium to long term, still the vast majority of the people are going to answer to you that, yeah, okay, it's moving lower now, but at some point it's going to resume its appreciation. And that's something I always want to keep in mind. I mean, what's the view of the vast majority of people, having to do with the longer term, because, we tend to really not assess right what's going to happen in these cases. Now, having to do with gold, since you happen to mention it, keep in mind that I don't have short exposure in gold, but I do have in palladium, because I thought it's an even better trade in the sense that it's also very, very responsive to risk, and I thought that the risk is going to sell off. But keep in mind that gold is actually pushing below this low, and this likely invalidates the potential of a triangle. And especially if we break below 1,300, I think that gold is going quite lower from here. So you really need to be careful. Now, silver is
1286, where that moving average comes in, or attack the lows from December.
No, I think if we break below, there, we can really extend towards the 1260 area.
Okay, thank you, buddy.
Now, silver, also doesn't look really healthy. I mean, we had a descending trend line here. It never managed to pop above it, and I do think that another push lower towards the 1560s, 1575 area is more than likely as well. If you remember, I said many times that I'm a bull long term, having to do with silver and gold, but I was looking for more weakness in the short term. I attempted a couple of shots, got stopped out at break even in one. I took some profits in the other one. I took some losses in the other one. It ended up that when it finally moved lower, the structure had become so unreadable, at least to me, that I didn't want to participate in it. But at least, I feel happy because I still participated in the metals selling off through palladium, which served me, just nicely. But I do believe that you have to keep in mind that silver and gold now have spent a huge period of time being very, very difficult to read, simply because they're oscillating in large ranges, and they keep producing what seem to be strong and in the short term look like impulsive moves in either direction before they reverse course and do the exact same thing in the opposite direction. So in my opinion, you should be very careful trading them, because they can be very, very deceiving. Right? This is one of the reasons I also chose palladium, because I think that palladium had a very clear structure we had this ascending channel. We broke below it in what was more or less an impulsive move, and then we corrected higher. We came back, we retested more or less the broken channel at the 61.8, and that was a magnificent reward to risk ratio to go short. I actually had an order to go short at 1046, meaning when it broke that previous high there. So I got triggered like a couple of days ago, and you know it's been doing its things since. And personally, I would really be looking to hold the other half of my position if I get to 1000 and I'll get limited out of half of it, because even if we do an extension here, like a fib extension, and we take the first leg of the sell-off and the second one, you can see that we have a measured target of 890, right? Even if we want equality of legs. Now, I'm not greedy. I'm not looking for 890 because I have a clearly defined horizontal support resistance area here at around 900, 910. So, you know, I'll be happy. I mean, I have a limit order for the other half at 910. And, you know, I'm going to be more than happy. I already caught a big part of the sell-off from the first leg, the last part of the sell-off actually from the first leg, and I'll be more than happy to be participating in the second as well. I think that, you know, technically, as you see, it has been a very, very strong uptrend, which took us 155% higher, right? So once you've seen an uptrend that has given the market 155%, to be looking for a 20% correction is extremely normal and healthy, right? What is it? 20% after a 155% move, action of it, right? And since the first leg of the move, the corrective leg, you know, an ABC move lower. So you know, that was the whole concept here, and you know, that's why I was looking for palladium to be a much better market to trade than gold and silver to the downside. Okay, so let's have a look at a few questions because I'm pretty sure that we have a lot of them. Let me open the question box here. Steve, can you look at USD yen? Yeah, I had a look at it, Pedro, before I even saw your question, actually. If I'm still constructive on crude, yeah, that's a good question. Okay, so the question here in crude is very, very simple. Is it like stocks and palladium? So in essence, is this an A, B, C down to 55 and then higher, or is it more constructive than that? As I said before, I cannot exclude the possibility that there is one leg missing to the downside. I can definitely not exclude it, that this is going to be the final move, and then find support at 55. If you remember, that was the whole concept that prevented me from buying it at 58, because initially I said, I predicted that we were going to sell off from quite high, if you remember, and I said that 58 would be a nice zone to be buying, but then I saw it being too strong, so I thought that, you know, there is a good possibility that crude is not going to correct lower than that, although it took only a few days to go there, and perhaps it's going to move to new highs before then providing us with a stronger correction lower, right? And I'm still torn because I see that both possibilities, I mean, from a technical perspective, are viable possibilities. So the question is, when can we know if it's scenario A or scenario B?
When
you know,
if the S&P rally fails and we wash out, I think that they're Siamese twins joined at the hip right now.
Yeah, it's quite likely to be exactly what you're saying. But keep in mind, guys and gals, you don't always need to have a 100% clear view of a market, right? Meaning, since I'm a little bit torn because I liked 58 as a buying zone, I didn't like the fact that we got there very fast, then I liked to see one more leg to the downside, but I see more strength than I wanted to see to be selling for one more leg lower. What did I end up doing? Not participating in this market, right? It's okay. Not having a trade or having a conflicting bias in the short term, it's okay. I can tell you one thing for sure. My longer term bias here hasn't changed, which is what? As long as we remain above 55, yes, I'm absolutely constructive on crude, right? There's no question about it. As long as we remain above 55, I would be expecting crude to likely break above the recent highs that we've seen. So now, obviously, in the short term, I need a little bit more of a price action to determine if this was the end of a correction or one more leg is missing. If there is one more leg missing, now we can work here on assumptions, right? But it's okay because many times assumptions create trading plans. So working on this assumption, we had the high there, we had the low there. Let's assume that we've seen the high of a corrective leg between the two legs lower that we would expect in a larger correction. Where is the target? At 55.64. Where is the area that we've said is our bull bear line? At 55, right? 54.80, 55. So this looks also good. I mean, the fact that we have a potential for an ABC that will still not violate our 55 area is quite nice. So I guess that if we do break below this low of the outside white candle that we had, which is, let me see, at 60.80, the chances of another leg lower are increasing, right? So bottom line, this area, I guess that if we violate this low, which was also that high there, the chances increase for a second leg to unfold towards this area before resuming the bullish move. As long as we hold that area, there is always the possibility to resume higher from there. Okay. I can tell you one thing for sure, though, is that if we do sell off once again and we approach 55, I will be very actively looking to buy crude. I can tell you that with zero doubt.
Me too, or oil shares related to assets.
Yeah. And for people that only want to trade currencies, that would also be a nice area to be looking for a high in the USD NOK, right?
Canada.
In the USD CAD, right? Exactly.
Yeah, you're going to get your 131 if that happens.
Oh yeah. If we go down to 55, yeah. Pretty likely. Yes. So let's see. We have questions about the euro and the pound yen. Let's have a look at them both. Okay. We said that a failure of that zone would obviously accelerate the pair lower, and proof of that was yesterday's candle that took us from above 131 to below 130. Today's rebound so far is meager in comparison to the kind of sell-off we had, so I have absolutely no reason to be looking higher or to believe that we found a tradable low here. In fact, I think that the next serious area of support is like at 128.50 roughly, and I doubt that we're gonna rebound before reaching that. So things are quite simple there, and which means keep looking lower. And here's the pound yen. Now the pound yen is currently at the precipice of a disaster, right? Because in essence we have broken below every single one of the support areas we had, with the only exception being this trend line, this descending trend line, which if we also break below that, I think that the next stop is at 144.50, and I think that a weekly close below this blue ascending trend line more or less solidifies that perhaps this corrective move has come to an end and pound yen is aiming lower. And when I say lower, I mean significantly lower, right? So I think this week is going to be pretty important. I want to see how we're going to close tomorrow night, because I think that if we close like, especially below, let's say 147.50, 147, I think this is going to be a huge technical event for the pound yen, in which case I will in no case and no way be looking to the upside, but only to the downside. Okay, let's see more questions. If I can have a look at oil, yeah, we just did so. Euro CAD and pound CAD, if they are short, let's have a look at them. I can tell you as a fact that I will probably be doing nothing with them. Yeah, you can see why. Yeah, on one hand, we don't have much momentum to the upside, so this moves tells me that the bull momentum is waning. We already have a mature move, and it's likely that we're going to see the pair roll over for at least a corrective move lower, but I have no trigger to do so, right? And as long as, for example, as this trend line holds, I would, even a sell-off, I would be more inclined to be buying it than selling it. Having said that, before we roll over, there is even the chance that we're going to extend a little bit higher to perhaps reach the 161.8% extension at 157.70 of this move lower. So personally, as I've said the previous days, I would be doing absolutely nothing with EuroCAD at the moment, right? We also have some RSI divergence, so I do see the signs that we might have some move lower from here, but really this is not a clean chart. I mean, why would I want to be involved with that? Same here with the pound CAD. I mean, the pound CAD is still constructive. Since we had that inverted head and shoulders, we've been pushing higher and higher, and we've been posting higher lows and higher lows, and we tagged that area of highs there, and for the time being, we've sold off a little bit, but still, do I have the reward to risk ratio to be buying here? Absolutely not. On the other hand, do I have like a strong signal that I should be fading this move already? No. So yeah, we have some RSI divergence, we have like momentum that has weakened, but I don't want to do anything with these two pairs, honestly. I'm going to keep monitoring them. If we get some stronger signal, I might get involved with them. But for the time being, I just want to stay on the sides and don't even have nothing really technical here, honestly. I just don't want to be involved at the moment. But you need to respect the fact that they've been moving higher for several months now, right? So just don't try to jump the gun, in my opinion. Pound Aussie and pound Kiwi, let's have a look at them. Same situation here. I mean, obviously, a very nice breakout from a large, might end up being a bottoming formation, we'll see. But do we have like upside momentum? No, we really don't, right? This looks more like a big consolidation after a breakout. So not really looking to be involved with pound Aussie as well. I think that the easy move higher for some time has already finished. Same here with the pound Kiwi. The pound Kiwi might be coiling after breaking above this larger formation, this one, right? So it might be coiling, and this might be like a bullish consolidation, but we need a break higher to confirm. And for the time being, this descending trend line, the red one, has been capping price action. So as long as that's the case, why would I want to sell it or buy it here? I'll keep monitoring it until, I like to go into trades when the technicals are so clear that I feel the urge to jump in the market. You know what I mean? I really want to jump in the market. I'm not trying usually to persuade myself that something is there. I want the market to leave me almost no alternative but to participate in it, right? Like, knocking on my door.
Compelled. You're compelled, which I'm compelled to begin our interview here.
Oh, yeah. Absolutely, Dale. Enjoy the interview, mate.
All right. Thank you, Steve, for a great roundup of the whole board, like usual. Patrick, I see you in the house. I'm going to now make you the presenter. I'm not sure if you are going to show any charts. I'll make you the presenter. If you're not going to show a screen, I'll show your website for you. I want to welcome you to FACE. Looking forward to hearing your voice. How are you today, Patrick?
I'm great. I don't have any charts, so show whatever.
Okay.
Whatever you have.
All right. Well, what I'm going to do is I'm going to show your mug and the Malden website. Let me just get that up for everybody, and we're going to be talking about the trade war, which we've had a lot of opening salvos. The first one being, let's see, there we go. First one being with solar panels. But before we start that, Patrick, and I went to your website, and God, your writings have been everywhere. Forbes, Business Insider, Investors Business Daily. You've been working with John Malden for 3 decades. You look too young to have been in this business for 3 decades already. So why don't you tell us a little bit about how you got started in the industry and ended up being an analyst and a financial writer and manager.
Yeah, so, well, years ago, I was intelligence officer in the Army. Then I got out and went into a doctoral program in political science and ran into John Malden in a strange scenario, and he convinced me that wasn't the direction to go with my life. So I went to work with him, and this was in late 80s.
Wow.
And stayed with him a few years, and we did some cool stuff. And then I went to work for a futures brokerage that he was a partner in. Stayed there for a long time. That was called Pro Futures.
Pro Futures, okay.
Yeah, small brokerage in Austin. And
right.
We ran commodity pools, hedge funds, other interesting things there.
Okay.
So I worked there for a while. Then I went to a registered investment advisor that did market timing with mutual funds and ETFs. It's called Capital Cities. So that was fun. I was an ETF trader for a while. And John and I sort of stayed in touch all this whole time. And then opportunity came up to go back to work for him. And so I did that, I guess, 3 years ago now.
Okay. So, yeah, interesting journey, and an intelligence officer. So you kind of were trained to look under the surface for messages and intelligence. And, I'm a big believer in intelligence gathering. That's why you're here today, Patrick, because, I reach out to experts to edify the community. And what a timely topic. I believe there's some type of vote on the steel trade issue. And I'm very interested in what you think the market implications are going to be. I read your piece, and maybe we could start with, wasn't the opening salvo against China for solar panels? And what was interesting is they didn't retaliate against U.S. manufacturers of solar panels, which there aren't a lot. What they decided to do was buy more of their soybeans from Brazil to hurt U.S. farmers and hurt exports of grain. So why don't you tell us what you're seeing and what's on your radar here?
Right. So, well, as we know, even from before the election and the campaign, Trump was always had a sore spot for China in a variety of different ways. And you're right, the Chinese are very clever about these things, and they respond not in ways you expect, and they respond asymmetrically. So there's a lot of directions this could go. the weird part on that solar panel deal is the companies that brought the case in the U.S. asking for relief were actually owned by Chinese investors. So it's really murky on who's winning and who's losing. But that was, as you say, the sort of the prelude to what's much bigger, which is what may be happen, or apparently is going to happen today on steel and aluminum. And the background here is that Trump can't do a lot on tariffs without Congress, except under certain conditions.
Yeah, I found that very interesting, Patrick, that, you know, which is really Trump's authoritarian style, to not need Congress to do anything. It's all he has to do is claim that it's in our nation's defense to do this, and he doesn't.
Right. So Congress. There's a 1962 law that has rarely been invoked that allows the president to, if the Commerce Department makes a finding that some sort of imports are threatening U.S. national security, it empowers the president to impose tariffs and or quotas, and gives him very wide latitude to do that, and he does not need permission from Congress. And that is, there's a process he has to go through to do this, but it's a giant loophole, and he's driving a truck through it. So last year they started this process. Commerce under Wilbur Ross began this investigation, and just 2 weeks ago released the results of this that determined that yes, all these imports are in fact harming U.S. national security, and made recommendations to the president that they gave him several options. One was a global tariff on all steel and aluminum imports. The other was a targeted tariffs and quotas against a list of 12 countries. And then some other lesser tariffs and quotas. And they're different for steel and aluminum. So under this process, Trump had until April to decide what he was going to do. We learned last night that the schedule has apparently been accelerated rapidly, and there's some sort of announcement coming today. We don't know what it will be, and there's all sorts of, even in the best of circumstances, you never know what this White House is going to do. But it looks like they're going to do something harsh. The president tweeted this morning that he's upset with other countries about steel and aluminum. So,
well, he's also upset about Hope Hicks not, hanging out with him for a while. So, you also described the messiness of this, Patrick, in your piece. For example, on steel, that the Canadian steel industry was basically started to support our defense industry. And if we slap tariffs on them, it's almost punishing them for being supportive of our national defense. So there's all kinds of, strings and messiness about going down this road. Is that true?
Yeah, absolutely. And it's not just Canada. The list of the 12 countries that Wilbur Ross recommends we retaliate against, let me just grab that here, includes several other allies. I mean, there's China and Russia on there, but also South Korea, Malaysia, India, South Africa, Thailand, Vietnam, several of these other Asian countries that, in theory, we need on our side to contain China, and they're on the list too. He may end up exempting them. We don't know. But yeah, this is just weird that countries that on the military side are our allies, we're about to label them, some of them, national security threats.
Okay, so I don't know about you, but the big guy in this battle is obviously China. And, a lot of things that we need in this country are manufactured in China. In fact, I read that our transformers, if we ever had a power grid problem, that we don't build them anymore. They come from China. So if we had a grid problem, we'd have to wait for months just for them to get to the U.S., and they come from China. China has already stopped buying. They're not buying bonds anymore. They could, if they really wanted to retaliate, begin to liquidate their bond holdings. So is China the big guy that we have to really keep an eye on for, the world order and the continuation of bull markets and asset classes to continue? And, now that this has started, why don't you give us, I don't know if there's a best case scenario, but where you see after steel, where else we could go, and how do you think these countries are going to respond to these tariffs?
Right. Well, China is indeed huge in almost everything, and the global trading system is so dispersed and integrated at the same time that there's all kinds of things we have to get from them. There's things they have to get from us, and when you start throwing tariffs on each other, as we're about to do, it's very difficult to predict how it will go. It usually doesn't end well, but the Chinese are particularly adept at this, and they have lots of ways they can retaliate, for instance, against U.S. agriculture.
Right. That what they're already doing. They're going to other producers like Brazil. Are there any analogies with how this is starting? And, in the 30s, China wasn't as big of an economic player on the world stage as they are now. Between now and the Smoot-Hartley legislation in the 30s, do you see any parallels between that and what's beginning now, or differences?
Well, I'd like to say there aren't, because that was not a good move that Roosevelt made back then. But it did start this way. These things start small and then turn into something bigger, and it's often beyond the control of even the leaders. They have constituencies in their own countries, business interests, and sometimes voters that they have to listen to. In China, it's not a democracy as we understand it, but nonetheless, the government is very focused on keeping the impoverished public happy and docile, at least, to where it's not creating headaches.
Okay.
So there's a lot of things they could do, and it rarely ends well.
Okay, so why don't we get to your bailiwicks and what you do for Malden Economics? And you write about growth and income funds. Do you guys manage funds, or it's strictly an advisory service?
We are not money managers.
Okay.
But yes, I do write
okay.
two of our paid services, one about income investing and one about option income.
Yield, shark. I like the shark in there. So, and connecting the dots. So with this happening, what are you advising people to do in growth and income and yield? The bonds have been, finally, after, rates have been going up very slowly, but for over three years now. I mean, the 10-year bottomed at 130 quite a few years ago. What are you advising people to do as far as growth and income in this interest rate environment?
Right. Well, I think for the most part, equities are overvalued. I don't see. I differ from some on the long bond. I don't see the 10-year going a whole lot over 3%. So
okay.
at this point, I'm trying to keep credit quality fairly high and duration low. On the equity income side, this does get wrapped in with trade. what's happening in the very big picture is borders are going up everywhere. They used to not matter. We went through this whole era when we had some semblance of free trade and stuff could flow back and forth. That's reversing. And the weird part is the way it's reversing, we're headed toward a world with 2 free trade areas. And those are going to be the United States and everywhere else.
Okay. Oh, okay. All right. So we're really going to be completely isolated. Do you think that NAFTA is going to fall apart?
It may. And it's certainly going to change in some ways that aren't really predictable right now. But the borders around the United States are going to become more and more impenetrable to any kind of trade. So
they might also become impenetrable for U.S. citizens that want to get the heck out of here.
well, yeah.
What do you think? I mean, you know, they say they want to build a border wall to keep people out, but maybe it's to keep us cattle in producing. What do you think?
Well, I hope that's not true.
Anyway, so do you have any belief on how this is going to affect, say, for example, the linchpin we're currency guys here and gals? What impact do you think it's going to have on the dollar? You think that's going to be bearish the dollar if this continues to escalate, or bullish?
Yeah. So I'm certainly not a currency trader, so I'm not the one to ask about what's going to happen tomorrow.
Okay.
Over time, I think it will mean a stronger dollar, and that's not going to be good for a lot of emerging countries. It's because the U.S. will continue, or what Trump is trying to do, and he may well succeed, is to make exports outweigh imports, which will mean fewer dollars floating around overseas.
All right. Okay, interesting. All right, so we could end up having, that would be kind of deflationary long term if the dollar appreciates, because there aren't enough dollars out there right now to service debt, and it's easier to service debt with the debasing of the dollar rather than an appreciation of the dollar. Any view on commodities with what's happening here with the trade war? Could this be the time that precious metals begin to take center stage again, or views on oil, since we have now become an exporter, not just an importer of oil? Any view on those two?
Yeah, that's a related factor that's more important than I think a lot of people realize, is that without importing so much oil means we are shipping fewer dollars overseas to the Middle East, which further reduces the dollar supply outside the United States, which is going to make those dollars more valuable. And that gets back to the steel even. You know, what is one of the main uses of steel in the United States is the pipelines that go into our energy industry, which we're trying to grow, or is growing.
Okay. Yeah, so I'm getting the picture that a trade war, rather than, you know, what a lot of people are talking about is, you know, the death of the dollar and the end of its reserve currency status, is actually going to be the opposite, which, you know, when the dollar goes up, most things go down. It's kind of deflationary. I mean, that's what's happening. So what I'm gleaning from you is the trade war is going to be pretty bullish a dollar, so we should be looking for dollar buying opportunities as this progresses. Anything else on your radar? What are you writing about in your column when you say connect the dots, connecting the dots? What are the dots? What are you telling your readers in connecting the dots?
Right. So I try to look at macro trends and put together different pieces that don't necessarily seem connected at first. But trade is a big part of that. Trade and currencies are the circulatory system of the global economy. They're what tie everything together, and it's getting bollocksed up right now. And
okay. So
what I think
and
is going. The beneficiaries of this, of where we're going, are going to be consumers and businesses who don't need anything to cross the U.S. border. So if you're a business whose supply chain, yeah, that's a good question. But if your supply chain and your customers are both in the United States, you're going to have a relative advantage over anybody that depends on raw materials from overseas or that is trying to export overseas.
Yeah, and are there many, you know, major corporations? I don't think would fall into that. So this could be a boon for small business in America. But who doesn't need things outside of our border? I'm having a hard time wrapping my head around, you know, how we could be, you know, America as an island without being able to get things from overseas. Who would benefit? Yeah,
that is hard to see, and it's really hard to dig into, because you can look at a company's supply chain, but then you got to look at the supply chain.
Right.
Where does all this come from? I'll give you one name that I found that's no, I haven't found anyone really perfect on this, but one name that's better than most, and it's kind of a surprising name. It's Dollar General.
Okay. Yeah, so they don't have a lot of their goods manufactured in China, like a lot of other retailers or discount stores, like Walmart. It's very dependent on Chinese manufacturing, right?
Correct. Yeah. If some magically China imports were to stop overnight, Walmart's shelves would be practically empty a day or two later. They can't survive without that.
All right, so that's a good point, and I want to wrap it on this, Patrick. Is a trade war going to cause major shortages in not only, you know, luxury goods, but necessities for Americans? Are we going to have shortages in, say, we have a bad crop year with a weather market from La Nina, and we have a drought in the Midwest, and we need to get grain elsewhere? Are we going to be looking at severe shortages in a lot of different areas for U.S. citizens if this continues?
I think you could see spot shortages in some goods. I think more likely you'll just see higher prices.
Okay. All right. Higher prices. Okay. So there goes the tax cut. So, Patrick, what's the best way for people to follow your work? And I see here you have quite a team on About Us. Besides John, you have a whole list of people that are working and contributing to your advisory. This is Patrick's website where he contributes to Malden Economics. And are you active on Twitter? I have your Twitter handle as Patrick W.
Yeah, really the best way to follow me is on Twitter, and it's very simple, at Patrick W.
Okay.
And my company, Malden Economics, is actually having our annual macro event in San Diego next week.
Oh wow!
It's a little late to go. We'll be having a live blog, and there's a audio package and live stream you can buy. So look on our website, maldeneconomics.com, and you'll see information about that.
How come Dale Pinkert isn't speaking there? Ever hear of the guy?
Yeah, horrible oversight. I don't know how that.
Well, Patrick, thank you so much for your time today, and I found your piece on this trade war fascinating. Especially, a lot of people think that that President Trump's going to need congressional approval to do all these things, and he could be like a king and just say everything's for national defense purposes. And let's get back together as things unfold and hope for the best and prepare for the worst.
Yeah, glad to talk with you, Dale. I appreciate it.
All right, Patrick, nice meeting you. Good hunting and continued success, and congratulations on pointing your people in the right direction and having them be prepared for what most people have their heads in the sand about. So I really appreciate your time today. Say hello to John for me, and good hunting, my trading warrior brother.
My pleasure. Well, we'll do that. Have a great day.
All right, Patrick. So that's a wrap, everybody. Thank you, viewers from investing.com. Let's see how the market recovers. If you take a look at the S&Ps for a continued washout, I don't want to see S&Ps back above 2735. If it gets there, it's a shot for a short. If this washout is going to happen into early next week. And I'll see everyone in the member chat room. You're very welcome, Bob. You're very welcome, Abdul. You guys have a great day. And remember, don't just count your pips, count your blessings. We'll see you for TGIF tomorrow. Thank you for your attention. And thank you for your support. Adios.